Hey guys, what's going on? It's been a few weeks since I did my last video, and long story short, I've been having technical difficulties. My laptop was messed up, now I fixed it, and I was too lazy to fix it, now I did, and hopefully I'm going to be doing a little more videos in the coming weeks. But anyways, what is the theme going on in the marketplace right now? It's the beginning of volatility. We're not quite there where I think volatility is going to be at later this year, most likely starting in September, October, but we shall see when it's actually going to pick up. But if you look at the actual markets, they've gone nowhere, right? And I attribute that to a lot of confusion going on and what the Federal Reserve is actually going to do with the rate hikes. A lot of people in the alternative media saying, hey, we're not going to see any rate hikes. Peter Schiff is saying the same thing. I, on the other hand, think that they're going to raise rates, but it's not going to be as significant as what maybe other pundits are talking about. I'm thinking maybe 12, 13 basis points they're going to start raising rates. Most likely in September, but we shall see when they're actually going to do that. But if you want to look at elsewhere, overseas, the German DAX is higher. If you want to look at Chinese markets, Japanese markets, those are going up. But what I want to talk about, which no one really is focusing on as much, is the European situation. Europe, their bond market, especially if you want to look at Germany, if you want to talk about what I feel is a bubble, you may not feel it, or Wall Street may not feel it's a bubble, is the bond markets in Europe as a whole. I mean, if you want to look at Germany, for instance, their 10-year yield as of yesterday is at 0.08 basis points, right? Or, excuse me, 8 basis points. So that's nothing. That's where maybe a short-term yield security should trade at if you're a strong nation. And if you want to look at the United States, for instance, their 10-year yield is yielding approximately 1.89%, somewhere around that range. And the United States, obviously, we're the best out there, even though we have a lot of problems, no doubt about that. Even at the peak of QE, we had the 10-year yield trading at maybe 1.42 or 1.38, while the German DAX, which sounds ridiculous, is trading at 8 basis points. The French 10-year yield is trading at 37 basis points. The Italian 10-year bond, it's actually been yielding higher, the interest rate. If you want to look at it, I think it's maybe 1.4 right now. It's gone up, I think, 40 basis points since the low of this year. I mean, I was trying to find someone where I could start shorting this market because I don't want to use ETFs. ETFs are crazy. I don't think there are any ETFs out there to do that, and it's not the best way to do that. Now, if you want to look at the futures market, that's dangerous. And then if you want to look at shorting the actual bond itself, well, that's also a little dangerous as well. So, putting all of this together, if you want to look at Portugal as well, if you want to look at Spain, those yields are starting to rise. Now, we shall see if this is just a short spike. But, long story short, we know that Greece is going to leave the Eurozone. So, if Greece is going to leave the Eurozone, how are market participants going to act? You have to remember that all of this is interconnected. The German banks own a lot of Greek debt, or they used to. If you want to look at all of these European entities, they're connected. Now, the next question is, who owns what? What derivatives positions do these individuals have, or these market participants have? And the thing is, like in 2008, no one knew who had what. And in my opinion, the same situation is going to arise. So they're trying to quarantine Greece right now, but in my opinion, that's not going to work out. Long story short, I feel like Greece is going to leave the Eurozone this year. After that, the markets are going to attack the bond markets of Italy, Portugal, and Spain, the remaining pig countries. And then after that, they're going to go after these sovereign bonds in France and Germany. And before I go on about this, you have to remember that if you're going to actually short these bonds, it's really dangerous. So I'm really iffy about shorting these. So the way that I want to get into this mess is maybe using put options. But still, it's still difficult doing that if you're a retail investor. It still is possible though. But anyways, looking at all that, you see all these individuals going to Germany. I want to go back to Germany again. Their 10-year yield is yielding 8 basis points. So long story short, what are these guys thinking? Why would they want to do that? Well, you have to remember when the yields go down, bond prices go up. So these guys are long the bond market in Germany. And people are desperate for yield because they don't know what to do with the money. Do they want to go into equities? Do they want to go into bonds? Because bonds, you have to remember, everyone has gone to bonds the last 30-some years, and yields have been going down in these affluent countries. So that's where people are putting their money to work. They're thinking, hey, deflation, bonds go up no matter what. But now the weird thing about it is all these bond managers, they've taken a poll, and they've indicated that the bond market seems expensive. And people are still thinking that the bond market is expensive in the United States as well. Putting all this together and what the Federal Reserve wants to do, if you want to look at what even Stanley Fischer has said, he says that right now it's a really, really easy monetary situation. He said this in a CNBC article or video. And then he said that we're still going to have an easy monetary system, but it's not going to be as easy. Paraphrasing what he's stated in that interview. So what he's trying to say is that he wants to raise rates, but really slowly. So if you start to raise rates, even in a deflationary environment, what's going to happen to bonds? In my opinion, bond prices have nowhere but to go down, and yields will go up. Interest rates will rise. Now, we shall see when this will happen. I think September is going to be the day, even though I feel that the economic data is lousy. But remember, Wall Street looks at data in a different manner than what normal people do, right? Normal people are saying, hey, the economy sucks right now. I can't get a loan to buy a house. And you know what? My wages aren't going up. So I totally understand and sympathize with Main Street rather than see what Wall Street's saying. Wall Street's saying it's fantastic. Dow is up. It's only fantastic if you're in the 1%, right? If you have a job, you're all right. A decent paying job and can pay the bills, okay, you're fine. But there are a lot of people that are struggling right now. Long story short, what I feel happening is the European situation is a nightmare. It's a mess. Those individuals that are trying to find yield in the bond market, these heavy hitters, I feel that if they don't have any puts or anything like that, and they're just buying bonds thinking that, hey, it's always made money, I think those guys are going to be on the short end of the stick. But we shall see. Who knows? I mean, you have to look at some other bonds. They've been doing well the last 30 years. Maybe they're going to have another 5-year bull market. We don't know. I just think that those individuals long the bond market, well, you should be protected in some way, shape, or form. Anyways, guys, leave a comment. I will do some more videos this week. Talk to you later. See ya. Bye.